It's Thursday and you're watching FreightWaves Now. Thank you so much for tuning in. Coming up, we're going to have Donny Gilbert giving us a broker update. We also have Mike Baudendistel with the used truck intermodal update. But first, a word from Strickland with a carry update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your carrier update presented by PowerFleet. I'm Strickland, and today I want to talk about freight volumes in the United States. So we talked about tender rejections yesterday. Capacity overall is falling off a cliff. You're not going to see a lot of activity on the spot market here over the next few days, probably a few weeks at that. But we're just really not seeing the activity on the spot market that we thought we might. But again, it is January, so it is pretty standard for this time of year. But volumes overall are flat year over year. And the reason that's interesting is because a lot of the volume that we saw last year came from the Los Angeles markets, the Southern California area. With all the freight pull forward, the tariffs, the trade war concerns, and all that kind of noise, and it's not there this year, but yet we're still about right on par with volumes of 2019 this time last year. You can see this green line here follows that blue line almost exactly as we move through January, and we're starting to hit the end of the month here. So what does that mean nationally? So nationwide, it's not the same market that we saw last year. Over here on our chart to this side, you're going to see all the regions broken out in terms of volume. And I want to display that just so you can tell exactly how the market is divided in terms of national volumes. You've got the Northwest region down here, which is the smallest region overall in terms of volume with a 367. Now that has been the largest grower in terms of percentages. As you can see over here on this side, I've got this listed by value of growth, year over year change in percentage. Northwest leading the country. The Northeast up 13%. Now the Northeast is interesting because it is a little bit bigger region overall. If you look at this one, you're going to see the orange line right here. The Northeast is a pretty good size region, I should say, and that's grown 13%. That is a significant increase. So that whole storyline about how we've shifted from the West Coast preference to the East Coast is really driving volumes to the East Coast here over the last month or so. Now, if you look at the few other markets here, the Southeast roughly down 2 to 3% year over year. You look back over here, the Southeast really not showing a lot of activity. A lot of that has to do with Atlanta not growing like it was. Again, looking at the Midwest, they're up about 4%. So that's pretty good news for any of those Midwest carriers up there. You should still be seeing a little bit extra volume this time versus last year. Now, the worst market to operate out of, the West, again, Southern California volumes have plummeted, fallen off a cliff. A lot of that went to the East Coast. So what does that mean in terms of markets? So some of the largest markets, I've picked out some of the largest markets in this graphic, this illustration. Joliet in Chicago, Elizabeth, New Jersey, where a lot of the freight volumes have really grown year over year, Ontario, where they've died, and the Dallas market. So picking on each region's kind of hub, and Atlanta, of course, down there in the blue. So you can see Atlanta down roughly 3%. And then you've got this green line right here. That's the Elizabeth, New Jersey market. So again, the Port of New York, New Jersey up there, a lot of the freight's coming into this area. We've seen a big shift of freight volume to that area, not just on the ports, but also because people have built out DCs and warehouses, and they're trying to get closer to the population centers. So a lot of short haul volumes, but also a lot of long haul volumes coming out of that market as well. So it is a little bit of a conundrum, but at the same time, it's a growing market. So overall, you can see that the yearly change in Atlanta down 3.4%. Ontario, California, 26% down year over year. And then you have Harrisburg right there sitting at about 1% up. And then Elizabeth, 36% up year over year. So pretty significant shift in the overall market year over year. We've seen this West Coast drive dying, and now the East Coast is starting to live up. So everyone, have a great Thursday.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Thank you, Zach, for that update on volumes. I am going to jump into tender rejection rates, though. We're going to look at today both dry van and reefer. But the way I want to start with this is I want to start with the map that I always love to look at, and that is the actual change week over week in tender rejection rates. And we're going to start with dry vans. So right here behind me, we see a lot of red in this map, which is, as we're talking, a lot of these tender rejection rates have been falling off in a lot of markets. Now, the blues are areas that have picked up. This map does not mean that rates are picking, or it means that the tender rejection rates are changing, but it does not mean that these are high rates in these blue areas. It just means it's increasing. It could be increasing from 1% to 3%, but this is a good map to use so that you can see what trends are happening in which markets across the U.S. You see some markets here in the Southeast are turning a little bit blue, but a lot through the Midwest and throughout the Northeast are turning red, which means our tender rejection rates are falling week to week. And of course, it being in kind of the last week of January here, this is what we do expect. Now, making a change here, this is our actual tender rejection rate map. This tells us what is going on currently with tender rejection rates and their actual numbers. Keep an eye on the legend below here. You see as the blues get darker, tender rejection rates go up. Our highest tender rejection rate right now is only 21% for the overall. But you see tender rejection rates in the Northeast here are a little bit elevated through some of your markets in New York. Now, taking for granted that New York has very low contracted rates, it's still a rough market to run your trucks into. Some of these here across the Midwest here in the Iowa region, these are elevated tender rejection rates. These are actually good areas that you might want to send your trucks. The Southeast, they are starting to pick up, but they're still relatively pretty low tender rejection rates. Now, jumping over to some markets that we might want to look at here, Rock Island, New York, 16.33% tender rejection rate. Des Moines, 15.53. Elmira, New York, 16.76. And of course, Mobile, Alabama is holding at a 10.43% tender rejection rate. So that's still a pretty strong market in the Southeast. Jumping over to reefer again, we're going to start again looking at the tender rejection rate change week over week. So here we see a little bit less red and a little bit more blues. For this map here, we got markets in Virginia, markets in Florida that are picking up. Again, this doesn't mean they have high tender rejection rates. It means they are increasing for week over week. We have a lot of our normal freight that runs on reefer trailers, plus we have our Protect from Freeze freight that's now running on these trailers as these systems move in from the Pacific Northwest and cools down, of course, the Midwest. Going forward here, this is our reefer tender rejection rate map. This shows the actual rates. You see Arkansas, Memphis are strong markets to move into. Of course here, Nebraska, Iowa, and of course Indiana here in the northwest of Ohio. So here are the markets that we're looking at for reefer, and of course we got Salt Lake City, Idaho, and a little bit here in Washington still hanging on there with some stronger tender rejection rates. Jumping into some actual markets, we got Raleigh, North Carolina, 35.39%. We got Memphis is almost 48% tender rejection rate in Memphis. So if you're a reefer carrier, and definitely Memphis is a strong market. So as a broker, you know you're gonna get a higher rate. So look in these markets and of course boost your rates up. And of course Fort Wayne, Indiana is coming in here at 27, almost 28% as well. So these are some good markets to jump into. Realize with higher tender rejection rates that you're going to get a higher carry rate from these reefers. So boost your bids up and increase your margins.
Make sure to tune in to FreightWaves TV this Friday as we discuss the current and future state of freight. The FreightWaves research team has compiled the 2020 FreightWaves Freight Outlook, designed to give you an upper hand in an ever-changing industry. You'll hear in-depth analysis from FreightWaves CEO and founder Craig Fuller, head of research Kevin Hill, and so many more of our freight market experts. We'll also be taking live calls with any questions you may have for 2020. Tune in to the FreightWaves 2020 Freight Outlook this Friday at 2 p.m. following What the Truck.
Welcome to your shipper update. I'm here with Mike Baudendistel. Mike, what do you have for us today?
So today we're going to take a look at first at used truck prices. So one of the interesting things that came out this week was in PACCAR's earnings call. One of the analysts asked PACCAR's CEO, what's happening with used truck prices, and he said, he thought they were stabilizing. I mean, PACCAR has desirable equipment. Those Kenworth and Peterbilt brand names are desirable. They say they tend to trade about a 10% premium on the used truck market. So here we're testing that theory against three data series from Sonar, we have 5-year, 4-year, and 3-year-old used truck prices, and really up until the last data point or two, you see at the right there, they were pretty much in free fall. So you see, like for the 3-year, for instance, went from 70,000 to 58,000 at the latest data point. So those have really come down a lot in price. And what's happened there is the trucks that were produced in 2014, 2015 are now getting to be 5 years old plus, and those are about the time when you would trade in those pieces of equipment. So it's a buyer's market out there for trucks. And even though the last couple of data points have been stable, they've been stable at a low level. We're not expecting a big bounce. I think if you get into a situation where the truck prices come up a little bit, there's still a lot of pent-up demand to sell used trucks, coming from the rental fleet specifically. Those are the companies like Ryder and Penske, which are some of the biggest players in the used truck market. And the reason why this is important and why you want to look at this is there's been a lot of speculation, so much speculation that the second half of 2020 is going to have a surge in truck prices because of a tightening in capacity. These used truck prices, if they persist at a low level, those can really be a lifeline for some of that marginal capacity that really relies on the used truck market for its equipment.
Got you. And so is this something that you see not just being specific to one particular company, but really hitting the industry overall?
It does hit the industry overall. I think the ones that it probably hits the most would be the big sellers of used equipment, which would be someone like Ryder, and some of the buyers of the used equipment, which would be someone like a used or someone like a smaller fleet that really is not a new truck buyer.
Gotcha. And what do you have for us up here?
So here we're going to take a little bit of a shift to intermodal rates. I mean, one of the strengths of Sonar is there's a lot of intermodal data,
right.
And here just through what I think are some of the biggest intermodal lanes in the country, and we take a look at the intermodal spot rates, and really sort of seeing a mixed bag here. I mean, we did hear yesterday from Schneider that they were pretty optimistic on 2020 volumes, expecting the volumes for 2020 to be up in intermodal, and here you just sort of see it being a mixed bag. Gotcha. One thing that stands out to me here is Atlanta to Dallas plus 10, but Atlanta to Dallas plus 10, Los Angeles to Dallas negative 11. So it's actually a stronger intermodal rate, coming through the east going to Dallas, at least relative to a year ago. So we heard Zach a minute ago talk about the shift to the East Coast ports. We're seeing that in the intermodal data as well. And this next chart just digs into that a little bit deeper, where really going to Atlanta from the east, from to Dallas from Atlanta, up 20% year over year. Going to Dallas from Los Angeles, down 3% year over year. This right chart shows the same thing, just the absolute numbers, and here it just shows the volume, how much more important that LA to Dallas lane is. It's about 4 times the size. So that's part of the reason why you can see such a big jump up in say 20% with the narrower lane there.
Gotcha. And this is something that you see being a ongoing trend and something that's sustainable?
I think so. I mean, I don't think it's strictly a function of the tariffs on China. I think some of it is just overall production shift to Southeast Asia, and it's also these dramatic expansions at the East Coast ports, combined with rising rail intermodal pricing. So all of those things I think are coming together to push more of the ocean traffic to the East Coast ports.
Got it. Excellent. Thank you so much, Mike. And thank you so much for tuning in for this Thursday edition of FreightWaves Now. We're always posting around the clock, so check us out on all your favorite social media platforms. And we have our FreightWaves TV app, so check us out on all of your favorite streaming platforms like Apple TV, and of course for our Android users, we're available there as well. Thank you so much for tuning in, and we'll see you on the next episode.